Today, we're not just going to talk about US tax and immigration rules. We're going to deconstruct them. Look at them as an architecture, a system of incentives that's been deliberately designed to get people to do certain things. It's a pretty complex machine, and understanding how it really works is everything. And that brings us to this central question, right? It's kind of a paradox. How can someone pulling in a seven-figure income have a lower tax rate than someone on their payroll? Well, the answer isn't about breaking the rules. It's about a deep strategic alignment with the very systems the government itself has built. Okay, so here's our roadmap for this. We're going to start with the big picture, the system's incentives. Then, we'll get into the specific playbooks for business structures and real estate. After that, we'll see how these same ideas pop up in investment-based immigration. And finally, we'll connect all the dots to see how it forms one unified strategy. All right, first up, the system's incentives. Probably the biggest mindset shift you can make is to stop seeing the government as an opponent and start seeing it as a potential partner. The tax and immigration codes, they're not just about collecting revenue or controlling borders. They're economic tools meant to guide private money toward public goals. I mean, think about it. The government can't be the country's only landlord or employer, and frankly, it doesn't want to be. So what does it do? It basically outsources these massive jobs by creating some really powerful incentives, like huge tax breaks and special visa pathways for regular people and investors who are willing to step up and provide housing or create jobs. And this quote just nails it. It perfectly captures this symbiotic relationship. The investor solves a problem the public has, the need for housing. In return, the government gives them its most valuable asset, tax deductions. So it's a win for the investor, it's a policy win for the government, and it's a practical win for the people who need a place to live. Okay, so let's move on to our first big tool set and see how this actually works in practice, the business structure playbook. For anyone starting a business, picking your legal entity is not just some piece of paper. It is the fundamental decision that controls how every single dollar of profit gets taxed. So what you're looking at here is basically a fork in the road. On one side, you've got pass-through entities like an LLC or S-corp. With those, the business itself doesn't pay tax. All the profits just pass through to the owner's personal tax return. But on the other side, you've got the C-Corp, which creates two tax events. First, the corporation pays tax, and then the owners get taxed again on dividends. For most people, avoiding that double taxation is goal number one. But, even if you go the pass-through route, there's a pretty big hurdle, the self-employment tax. This thing is 15.3%. It covers both the employer and employee sides of Social Security and Medicare, and it hits every single dollar of net profit. As a business grows, that tax bill can get absolutely massive. And this is where the S-corp becomes such a brilliant play. It gives you a way to split up your income. So first, you pay yourself a reasonable salary as an employee. And yeah, that part gets hit with normal payroll taxes. But, and this is the key, all the profit that's left over can be taken as a distribution, which is completely exempt from that 15.3% self-employment tax. It's a totally legal distinction that can save you tens of thousands of dollars a year. All right, now for what is arguably the most powerful playbook of them all, the real estate advantage. This is where the system allows for something that sounds almost too good to be true. You can claim tax losses for expenses you never actually paid. The engine behind this is something called depreciation. Basically, the tax code lets you deduct a slice of your property's value every single year for wear and tear. And the crazy part is, you get to do this even if your property's actual market value is going up. Since no cash actually leaves your pocket, this deduction creates what's known as a paper loss. And that paper loss directly reduces your real taxable income. Now, if you want to put this on steroids, smart investors use a strategy called cost segregation. This is where you get an engineering study that breaks down the property into all its little pieces. Things like carpets, appliances, and light fixtures get reclassified so they can be depreciated way faster. Think 5 or 15 years instead of the usual 27 or 39. What this does is it crams all those deductions into the first few years you own the property, generating huge paper losses right up front. But here is the absolute game changer. Normally, those big real estate losses can only be used to cancel out other real estate gains. But there's a huge exception for short-term rentals. If your average guest stays for 7 days or less, and you materially participate, meaning you're hands-on with managing it, the IRS reclassifies the whole thing. And just like that, those massive paper losses can be used to wipe out the tax you owe on your main W-2 job or your active business income. It's incredible. Okay, switching gears a bit, let's see how this exact same logic, this architecture of incentives, shows up in the immigration system. Just like the tax code rewards people who provide housing, the immigration system is built to attract the resources the U.S. economy wants, and that's usually foreign capital and job creation. This table lays it out really clearly. It's a tiered system, right? The E-1 visa is for substantial trade. The E-2 is for a substantial investment, usually over $100,000, to run a business here. But the big one, the top tier, is the EB-5. That's a direct path to a green card if you invest at least $800,000, and this is the most important part, create 10 full-time jobs for Americans. Each visa has a different price tag for a different level of reward. And for that EB-5 visa, the scrutiny is intense. It is not enough to just have the money. You have to provide a crystal clear paper trail showing exactly where every penny came from and that it was all lawful. On top of that, the money has to be truly at risk. No guarantees you'll get it back. The government is incentivizing real, risky investment that builds the economy, not just selling a visa. So let's step back and connect all these pieces. We've looked at business structures, we've looked at real estate, we've looked at investor visas. And while they might seem like totally separate things, they're actually all just different expressions of the same core government philosophy. When you look at the whole architecture, the design principle becomes so clear. The system is not neutral. It is deliberately set up to reward the activities of owners and investors, the people who use their capital to create businesses and provide assets like housing. An employee earns $1 from labor, and that dollar gets taxed. An investor uses $1 of capital, and that dollar can generate both income and a tax deduction at the same time. So this really leaves us with one final thought. This isn't about whether this system is fair or not. It's about understanding how it actually works. The architecture is there, all the pathways and incentives are clearly marked. The real question is, now that you understand the mechanics, how do you navigate it? Which of these government design structures makes the most sense for your resources and for your goals?